Hi guys, so in the previous video we were looking at the higher time frame versus the lower time frame, and that's going to lead us into this, which is identifying your current trading range. So what I mean by this is looking at the trends that we've identified on the higher time frame, and we've identified our highs and lows, where our break of structures are, where our change of characters are. We can then create a trading range for ourselves to trade within. So based off all of those characteristics that we've identified, we have our direction, um, and it's allowing us to say, well, the probability is it's going from here to here, and the market is going to react somewhere within this range. So, for example, um, if I take what we did earlier on, so we have our 1 hour change of character here. So I'll identify this as my 1 hour change of character. We can then identify the high, the low, and then the lower high that was identified as our high that did its job to create the change of character to the downside. So that's a really systematic way of getting our high. We have our strong high, and again, I'll go into this in a later video. So we've 1 hour strong high, and then we have our low that failed to do its job. So this high created this low failed to make a higher high, so this is the low of our trading range. So then what we can do is within that range, once we've identified it, we can then see what's actually happening within this range. So we know this is our protected high, we know this is our weak low. Anything that happens in between here is basically us looking for our entry signal. Our bias is to the downside. Price came up, fell to make a higher high, and we can see here, for example, in this case, we have our order block. So if this was the case and price ran through, I would then be saying, well, this is within the range. I know price created a lower low. It failed to make a higher high on the higher time frame. It made a lower low as a chalk out of that. So we have this change of direction. We've identified the order block for it to pull back to as an example. And then I could say, well, my bias is short from here, because I know this has been a failure, so my probability is this low will be ran. So when I see a chalk coming up from the top, the failure to create a higher high, and it then gives me an indication of market downturning, I look for those levels, and again I can identify my 1 minute trading range in here. So I know within the higher time frame trading range I have this high. Let me just get it there, make this a little bit easier to see. This high created this low, so that was my trading range within this level. I can then see price came up to the higher time frame order block, and then I can see, is there an entry signal within this. So we could say, right, we had a high, failed to make a higher high. This does not count as a higher high because it did not close. And then this low was the catalyst that was then broken. This was the order block, again just using the same rules that we always have. I could then enter a trade within here and say we go short based off the order block, or if I need to drop sorry, that's a long, if I need to drop to a lower time frame within this, I can put my stop above the high that did its job, and then I can target the range low, which is here for a 3 to 1, or I can target the higher time frame if my confidence in my analysis is correct, and then I can allow that to target down towards the bottom. So by identifying that trading range that I'm in, I understand that everything up here is protected. These did their jobs, came down, made a lower low. I know, again, this is a 5 minute chart, so you could view that as a change of character, but because the higher time frame, for example the 15 minute, is stronger, this was the low, made a higher high, came back down, made a lower low, made a higher high. There's a chalk here in the 15 minute. I go multi time frame, there's no chalk on the 1 hour, so I'm still confident enough to hold my trade. If this makes a lower low here, so if it takes and breaks this low, I am pretty much certain then that this low will be ran on that trade. So defining those ranges gives you more confidence in holding trades for a longer period. It allows you to say, well, I know the higher time frame pull is stronger. I know that this low did not make a higher high. I know that I got an entry within here, and I know there's a probability that it should go lower. That's not to say that the price can't pull back up to here and then go lower. I just know within that time frame that I'm trading off of this, I can take those shorts with confidence. Again, you can see here that this might be an indication that it is going to push up a little bit higher, because there might be a bit of space up here. This is all within my trading range, and it's not improbable to happen. As I was moving down, I could have moved my stop below this, and then you can see there's no other real high there. I could have moved it down to this, but it didn't really do. Well, it did do its job. It got spiked out, so that would have been a trade. But in this scenario here, I wouldn't be overly confident that that is a change of character to the downside. Technically it is. I would definitely want my stop above this high if I was short in this scenario, because I know it closed. It doesn't look extremely strong. If I look at it in a 15-minute higher time frame is stronger. It did not close. To me, that's a sweep. It's probably going to pull this. I will be out of that trade within it. I'm still confident that this will go. It's just I've identified my trading range, and I could then say, well, if there's imbalance up here still, maybe it sweeps this high, I can then look for another short within that trading range. So yeah, just a really nice way to view at it, that the higher time frame is always going to be stronger, and it'll help you identify those key levels for yourself.